Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 260 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark.
How are we this fine Thursday morning?
Good start to the third quarter.
Yeah,
seeing
very
this
strong start.
Seasonal strength of inflows into the market, reflecting in strength in prices. Be curious to see how earnings season might change that narrative beginning Friday with the banks. Be really interesting.
Yeah, for sure. Definitely news will pick up alongside with volatility, most likely, over the next couple of weeks due to earnings season, and we'll talk about that here in a little bit. As always, we want to review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts, and as of the market close on July 10th. S&P 500 index up 3.2% for the month and up 18.1% for the year. The Dow Jones Industrial Average up 1.5% for the month and up 5.4% for the year. The NASDAQ Composite Index up 5.2% for the month, up 24.2% for the year. The Small Cap Russell 2000 Index up 0.2% for the month and only up 1.3% for the year. And the Vanguard All World X United States ETF is up 3% for the month and up 7.5% for the year. 3-month Treasury rate at 5.46%, 2-year Treasury rate at 4.62%, and the 10-year Treasury rate at 4.28%. Moving on to big headlines and current events from the week. As Matt had alluded to, earnings season kicks off tomorrow with JPMorgan, Wells Fargo, and Citigroup reporting first. And then obviously we'll have a large amount of companies reporting in the following 2.5-3 weeks probably.
For our newer listeners, Mark, will you kind of explain what the term of earnings season means and why that might have some more volatility associated with it?
Yeah, so each calendar quarter, publicly traded companies are required to report their financial results for the previous quarter. So we're in Q3 of 2024 right now. Companies will be reporting for the previous quarter, Q2 of 2024, to see how they did, just for transparency with the public, right? So, usually during those periods of times, investors are making buy and sell decisions based off of the financial numbers that these companies come out with. Also, there are what they call earnings calls, where the C-suite of the company gets on a call with analysts, and analysts ask questions. They talk through what happened in the quarter, what their guidance is going to be, how they expect to do for the next couple of quarters or the next half a year to a year. So, in today's day and age with technology, there's a lot of algorithmic trading surrounding just words coming out of an earnings call, right? So that's a reason why that volatility could tick up here in the next couple of weeks.
Well said. Masterclass right there by Mark McEvely. I love it.
And I was really excited about this, Matt. There's finally some other rational people in our industry talking about S&P 500 price targets.
I can't wait to hear this.
A big research firm, Piper Sandler, drops their S&P 500 target, saying the practice is futile.
Oh, love this.
Limiting market view to S&P 500 forecast is, quote, misleading, they say.
Love this.
This is the first of hopefully many to come. Realizing that S&P 500 price targets are useless and don't really do any good, but in my opinion, actually do more harm to investors, maybe who aren't as market savvy. So I was excited to see this yesterday.
Love that you bring this up. I have a piece in a little bit that is beyond a bold prediction. It's almost obscene by a very reputable bank. And I just can't wait to see what your reaction is. I think the listeners and viewers will be very intrigued by this piece here in a little bit.
Okay. All right. Well,
That's my tease for you.
Not
even our listeners and viewers. That's my tease for you.
All right. Moving on to tweets, articles, and research from this week. First thing I had was a tweet from Ryan Dietrich on June 28th. Jenna will throw this up on the YouTube video and it'll be in our show notes. He says the S&P 500 up double digits at the midpoint of the year. Full year, never lower, and up 25.1% on average.
There you go.
The rest of the year, meaning the second half of the year, averaged 7.7% higher and positive nearly 83% of the time. So
that's not bearish. That is not bearish.
No, and it's, obviously we had a very strong first half of the year. And we've, banged the drum on this several times over the past couple of months, so I won't spend too much time on it. But just because it was a strong first half of the year doesn't mean the second half has to be weak. But this kind of goes right into my next point, which was actually my third item, but I'm going to talk about right now. It's a blog post from Adam Turnquist at LPL.
Okay.
And Ryan actually used to work at LPL. So this was about volatility. So he says the lack of volatility has been quite impressive so far, as the S&P 500 index endured a maximum drawdown of only 5.5% in the first half. Despite the bullish precedents from a positive first half, bull markets are not linear. The maximum drawdown for the S&P 500 during the second half has averaged negative 10.3% since 1950.
So that would be normal.
That would be normal. That's average.
Okay.
However, seasonality data suggests dips should be bought in the second half. And he has this chart in here that Jenna threw up on the YouTube page here. And it shows the average percent gain during different periods of the year in blue, and orange is the average max drawdown.
Yes.
So the first kind of histogram on this chart shows all second half periods going back to 1960. So
yep.
Average return in the second half is 4.8%. And like he said a few moments ago, the average drawdown is 10.3%.
Love that you're highlighting this.
So if we look to the election year, that's all the way on the right side of this graph, average second half performance is 4.2%. Average drawdown tends to be 9.6%. So I think it's safe to assume that we still have not hit our largest drawdown or pullback in the S&P 500 yet, since it's only been 5.5%.
Absolutely agree.
Not saying it has to happen, but if we use the data, one would assume that there is going to be a larger pullback than that at some point later this year.
I would rather have our listeners and viewers of that mindset than to think that we're going to continue at this pace.
Yeah.
I could argue that if the presidential ticket remains, say, a Trump-Biden administration ticket, whether that is Biden himself or Harris, I could argue that if you go back to the last 4 or 5 presidential election years, the volatility might be less than average. I could argue that, but we got to understand that, political landscapes can shift very quickly. And I would just assume we're going to see maybe a double-digit pullback at some point the second half of this year. Just assume that's the case, looking at history.
And again, to remind listeners, what we typically see during election years is that pullback tends to happen between September and October.
It does.
So, this kind of is lining up nicely for what usually
the seasonality,
happens.
Right?
Right.
This is a good opportunity. If you're listening and you feel you are under allocated to risk assets and you have a long-term investment time horizon, I think this is a nice reminder that, from my opinion, you're still going to get turns at bat. And we talked about this in the first quarter, and we got that correction in April. And the question is, start getting mentally prepared for when that correction comes. It's not going to feel comfortable to buy. I can tell you right now. And be prepared that if you have a long-term investment time horizon, you're under allocated to risk, that's going to be your opportunity.
Yeah.
My opinion. So start getting the mindset, because when you're clicking that buy button, it's going to seem doom and gloomish. Make sense?
Yeah, for sure.
Okay.
Yeah, and it'll feel worse than it did in April if it's larger, right?
Because we haven't had much volatility.
Right. Last thing I had was an article by Emily Flitter at the New York Times, and this also had some commentary from people at Kitsis.com titled, "Why is car insurance so expensive?"
Oh, this would be a good piece.
So they say auto insurance prices have increased 22% in the 12 months ending in April 2024, with average 12-month premiums up to $1,280 a year. Reasons for the price increase, they say. Number one is the increase in the number of car insurance claims as more individuals hit the road as the pandemic receded.
Okay.
Number two, rising vehicle prices, which makes, a totaled car more expensive to replace.
Agreed.
Increasing repair costs due in part to the integration of technology throughout the vehicle.
That's a biggie.
Yes, for sure. And the fourth one was really interesting that I had no idea how this process works,
Okay.
but they say that state regulators review auto insurance companies' requests to increase premiums on customers to ensure they reflect increased expenses borne by the companies. And for example, meaning that their payouts to customers have increased.
Okay.
And that they're not just making an effort to boost profits. These state reviews can take time, sometimes several months. This gap between companies' requests for higher rates during the past couple years amidst an increased number of claims and the delay until their approval appears to be playing a major role in the recent sharp increase in auto insurance costs. As the insurance companies attempt to make up for losses incurred between 2021 and 2023, a total of $51 billion for the industry, according to AM Best. Don't know where that $51 billion number is coming from, but that's a pretty big number if that's accurate.
Huge number.
So, if you're one of those people that, along with the cost of most of everything else today compared to 2019, everything's a lot higher. And auto insurance, like I talked about, I think it was last week or the week before, I had a breakdown of the biggest inflationary drivers in insurance premiums.
Was on the list,
right? Yeah. So all this kind of makes sense to me. I know my auto insurance has definitely gone up, but this all kind of is coming together for me now.
Makes sense. I know that the price increases have been more dramatic on either end of the age band. Either you're younger or you're older, and I would define that as under 25, above the age of, say, 80, 85, those costs have really dramatically gone up from what I'm hearing.
Yeah.
For example, I'll select one of my brothers on this. He has a child who is of driving age, and you're talking in excess to insure this. Now they're in a major metropolitan area on the East Coast, but you're talking in excess of like $3,000 a year just to insure the driver. Mm-hmm. And I can tell you, when you and I were growing up, I mean, the price increase is astronomically above inflation.
Right.
Well
Yeah,
said.
it is. So that's all I got.
Okay.
Turn it over to you.
I got 4 pieces, but 2 of them are going to go pretty quick.
Okay.
So the first piece I think is going to be very insightful, not only for you, but for our listeners and viewers. And it has to do with property value increases in the equities that are now in homes and how this translates to the consumer's balance sheet. Why I feel this is fruitful is you've now seen 4 consecutive months of full-time job losses. And that's something that I think the listeners and viewers need to be monitoring. But we got to think about what is the American consumer's psyche the rest of this year, okay? And their balance sheet and the value of their home is a very important factor in that psyche. Well said? Mm-hmm. So watch this. We had a piece that I saw on Barry Ritholtz's blog over this past weekend, okay? And so this blog post, this is what it talked about. It talked about the amount of equity that is in homes right now. So Jenna's going to put up this chart that I saw on his blog post. The source of this chart is from the Federal Reserve and Liz Hoffman. And what you're going to notice here is going back a couple of decades here, Mark, it's going to illustrate mortgage debt and it's going to illustrate homeowners' equity, okay? So this to me is a good reminder that consumers could tap the equity in their homes if and when interest rates drop to pay off debt, consolidate debt, home renovations, purchase other properties, etc. Historically, this is what the American consumer has done. You're not seeing consumers do this en masse right now due to what? High interest rates relative to the last couple of decades. Having said that, one thing that is not being discussed is this huge amount of equity that's been built up that the consumer will most likely tap if and when these rates come down that could buffer concerns about the health of the American consumer. Mm-hmm. So I want to pause there. You know, this is definitely, I think, a topic that really just hasn't been discussed is, you know, forward thinking the next couple of years. If you have a slower downward movement on interest rates and they moderate, I think you could see a lot of consumers tap the equity in their homes, which for most people, I'm not going to move away from my sub 4% mortgage.
Right.
Okay. Now, to build on this, Seth Golden had a post on July 8th. Another thing it's talking about is consumer balance sheets remain healthy. The source on this data is the Federal Reserve. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. What this specific chart shows, Mark, is a comparison of some data from the fourth quarter of 2019 to the first quarter of 2024. And it has 5 line items: household debt, credit card debt, household net worth, U.S. GDP, and consumption. And all I'm going to do is verbalize the percentage change since 2019. Household debt's up 24%. But guess what? Household net worth is up 38% during that time period.
Yeah.
Credit card debt's higher by 20%. U.S. GDP's higher by 29. Consumption's higher by 31. So I just want to kind of throw this out there that if we're going to have a conversation on the actual facts of the state of the American consumer from a balance sheet perspective as a whole, I'm not subsecting out the higher end consumer, the lower end consumer. As a whole, I could argue on paper their balance sheet is stronger than it was 5 years ago.
Yeah, and I think something that gets lost in translation of the strength of the American consumer and how much longer, you know, the bull market can run is that people don't really talk about, you know, the amount of equity people have in their homes. It's like more than ever before today.
Correct, sir.
So there are relief valves for people to tap into if they want to keep their spending going. And I think that's a reason why, you know, these good times or, you know, high spending and consumption from the American consumer last than most people think a lot of the times, because there are other options for them to keep spending, even if someone does lose their job, right?
Agreed.
They have, you know, most of the time it's the biggest asset on people's balance sheet is their equity in their home.
And I'd argue the last 3 to 4 years of all these price gains, the average consumer hasn't even tapped that.
Right. So there are relief valves for people to tap into, even if credit card debt is higher. I mean, I've been hearing that a lot lately, like we typically do, but it doesn't really have any context behind it, relatively speaking, to incomes and the amount of assets people have, which I don't like.
Exactly why I wanted to highlight this today.
Which is great. So the only other question I have for you is this chart. It says money in the banana stand. I don't quite get that reference.
It's funny. It's funny you say that. I had to Google search this during my prep.
Okay.
And just in case you asked, here's the response. In the TV show Arrested Development, character George Bluff Sr. repeatedly assures his son Michael that no matter what other dire financial mishaps are occurring to the comically mismanaged family business, there's always money in the banana stand. They literally hid money in the walls of the banana stand.
Got it.
Okay.
Okay.
So I had to look it up myself because I didn't watch that show. But it's kind of like there's always money in the walls of the house,
right,
quote unquote.
Right.
So
it's interesting.
Good analogy, right?
Yeah, that's fun.
All right. My next piece is completely different topic.
Okay.
Topic number 2 is an interesting chart about semiconductor production. This was a post by Mike Zaccardi. He's a CFA and CMT. He did it on June 30th. Jenna will put up this illustration, this chart for our YouTube viewers. This will be in our show notes. This chart illustrates semiconductor production by location. That's a percentage of global share. Why am I sharing this? There is a narrative right now in the marketplace the last couple of years about the strategic importance of Taiwan. Mm-hmm. And for listeners and viewers that might not be as attuned to the topic, there's a lot of concerns about semiconductor production being a national security risk, and that the American government has passed some bills to financially incentivize tech companies to onshore production. And to take it further, the perception in the marketplace is that Taiwan is strategically important because of this. And you hear narratives that, oh my gosh, so much of semiconductor production is done in that country. I saw this chart by Mike, and it actually dispels a little bit of that narrative. Mm-hmm. I'm not trying to insinuate that Taiwan is not important from a semiconductor production national security standpoint. Mm-hmm. But the narratives I've heard in the marketplace the last 5 years is that they make up 40, 50, 60%.
One would think that it's, a half or 2/3.
Would you assume that?
Yeah.
Take a look at this chart. This is why I'm showing it. So it shows that Taiwan right now, at least in 2020, made up about 22% of global production semis. South Korea was drastically higher than I anticipated, Mark. They were at 21%. Okay. Japan 15, that kind of surprised me. Europe at 9, America here 12. China's at 15 in 2020. They're projected to see a huge global market share gain roughly over this decade. Mm-hmm. And then others account for the remaining, let's call it about 10%.
Man, Europe's just fallen off the charts. They were almost half of all semiconductor production in the 90s.
Isn't that something?
Now they're down to 9%.
I just thought that you and our listeners and viewers would find this insightful.
Yeah, well, it's, obviously here in Ohio, up in the Columbus area, Intel's building a massive semiconductor plant. There are companies bringing...
I think NVIDIA's going to piggyback off the same location too.
Yeah, and there's companies doing the same thing in Texas and all over the country. Arizona. So I'll still say that I think it would be an issue for the global production of technology if China were to invade Taiwan. And,
well, you combine it with China, let's say at 20%.
That's 50% of the...
And another 20, it'd be at least at 40.
Right. So a real, if we want to talk like catastrophic turmoil for the global economy, is if China invaded Taiwan and North Korea did something to South Korea
at the same time.
Yeah, I'm not saying that's...
I would agree with that statement.
That would be a huge problem.
It would be a huge problem.
Right?
Huge problem.
So, it's just interesting that I think just people have to realize just how important these things are for technology today. Every piece of technology really that you can think of in your homes has chips in it.
Same for military,
right? So, this is going to become a more and more important issue over the next couple decades.
I agree. I thought it would be nice to kind of show that, okay, where's the stuff actually made, Mark, right?
Yeah. And this was, and Mike put in here that this was a chart sourced from the JPMorgan Guide to the Markets that they do every year, which is a really good PowerPoint that I encourage people to look at. I look at it every single year. I think they come out with it early in the year, but
correct.
Have some really, really good charts and data in that always.
Thank you for the source. I appreciate that. This next thing, I'm not trying to poke the bear, but I'm also trying to poke the bear. So I know Jenna will get a kick out of that. So this is, to me, a jaw-dropping forecast. Okay, this was from a post of Vol Signals, and it says, quote, Citi suddenly looking for 8 rate cuts in a row, beginning with September's meeting. So what you're going to see illustrated, Jenna will put this up for our YouTube viewers. This will be in our show notes. This is beyond an aggressive forecast, in my opinion, because what they're illustrating is that at the September meeting, Citigroup, a major bank, is forecasting 8 rate cuts right in a row, taking the Fed funds rate from the low 5s to the low 3s by July of next year. My only thing I want to say before I hear your response is, if this comes to fruition, things are really, really going to be bad in the economy. It has to be a deep recession to see rate cuts that aggressive, that consistent. That is a very, very bearish prediction and bold.
Yeah.
Your thoughts?
Yeah, I don't really care what these people say about rate cuts anymore, because it's, we've heard this for so long, right? That, there were going to be so
very
many
outlandish
rate cuts
It's
this
a
year.
very aggressive stance.
Yeah, but on the other side of the coin, I guess, being my own devil's advocate, I kind of respect it for someone, throwing something out there that's just totally not on anybody's radar.
Anything's
right?
possible. Just like they could keep rates the same for the next year and a half.
Right.
On both sides of the coin. I guess I just look at it and say, if they really lower rates this quick, things must be really bad for them to do it.
Yeah.
Really bad.
Yeah. And I think if this were to come to fruition, I think Jerome Powell and the Fed would be like, okay, we were a tad late to start the cuts, so we need to make up for it. That would be what would happen in this scenario, in my opinion. But again, I don't really care what Citi says. I don't care what anyone else says about rates. It's like, until they actually do it, there's really nothing for us to do.
Okay. My last thing is S&P 500 index performance year to date. This is this past week from Bespoke Investment Group, taking out the Magnificent Seven. And for those that are wondering what those names are, that the market has coined the Magnificent Seven, it's some of the larger market cap names of the S&P 500, which include the likes of Alphabet, Amazon, Apple, Meta or Facebook, Microsoft, Nvidia, and Tesla. Not a recommendation for or against the Mag 7 or any of these individual names. Jenna will put up this chart for our YouTube viewers. What do I want our listeners and viewers to gather from this? It's pretty easy. You go from being up mid-double digits year to date, take out 7 of the 503 constituents of the S&P 500, and you're only up 4%.
Yeah.
That's dramatic.
It is dramatic. I'm glad you brought this up, because I think next week I'm going to have a piece kind of similar to this, because I think there's probably a lot of people out there that are like, guys, why wouldn't we just buy Google, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla, and the other 3 that round up the top 10 in the S&P 500? It's like, it's a no-brainer. Mm-hmm. But I think, number one, people are quick to forget what those names did in 2022. Some of those names being down 60 to 70%.
Preach.
And number two, I won't give away too much for next week, but there is data that suggests over the long term, the bottom 493 S&P 500 names is a better hold for long-term performance than the top 7 names.
Ooh, I can't wait to hear this piece next week.
Yeah, I'll leave it there for this week. But glad you brought this up. But the big thing is, people really, they block it out of their minds what happened in 2022 and in 2020, for those first 3 weeks of March.
Heck yeah.
Right? So everyone wants to be involved in these names because the returns always seem to be so amazing, but those returns have been so amazing because they've been cut in half or been cut in 2/3 before, not that long ago.
Well said.
So
well said. Well said.
Good piece there. We're going to skip the financial planning topic of the week. So it's kind of a lengthy one, and we're kind of hitting up to that half-hour mark that we'd like to stay under for clients. But just want to remind listeners that if you want to create your own podcast, use the promo code JessupWealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code JessupWealth, all lowercase and no spaces. If you're looking for an AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. Use the link in the show notes below to purchase your subscription and make life a bit easier. Before we sign off, Matt, anything else that you want to mention?
No, sir.
Okay, well, we appreciate everyone tuning in and listening to episode number 260 of the Independent Advisors Podcast. We will be back with you next week for episode number 261.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.